good people. Thank you very much for tuning into our channel. Today's video is about fintechs. Hope you enjoy. Fintechs are emerging everywhere, and the industry is growing very rapidly. According to a report published by the Institute of Chartered Accountants, Africa fintech is expected to grow 15 times from $200 million to $3 billion by the year 2020, with Kenya, Nigeria, and South Africa as the main countries. The fintech value system can be divided into two main segments. The first is payment, where the fintechs provide payment infrastructure for individuals and businesses. Here we have services such as PayPal, Alipay, Pesapal, and mobile money giant M-Pesa. The second is mobile lending. This is where fintechs provide access to microloans, competing in a segment that banks and other formal lenders often shy away from. Microlending is often referred to as microcredit, and it is the lending of small amounts of money to individuals or businesses. In microlending, the payment duration is often between 1 to 3 months, and the lenders charge monthly interest rates, which they refer to as access fees, and range between 1.5% to 15%. These interest rates, when annualized, come to between 18% and 200%, which is extremely high. This is when compared to the average annual interest rate of between 10% and 50% that is charged by banks within sub-Saharan Africa. Fintechs are attracted to microlending not only for the lucrative returns, but also because with the use of technology, they are able to use big data that they can package and sell. In this 21st century, data is king, and any company that has access to it can turn it into gold. Though the players vary by country, the big players across the continent are and many more. In developing countries, access to credit is limited. This is because many people in developing countries rely on informal and often inconsistent sources of income, thus classifying them as high risk for the traditional banks and other formal lenders. Digital microlenders are thus attractive to these borrowers because they offer loans to millions, if not billions, of Africans who banks often turn away. Why do banks turn these people away? This is because banks rely on traditional methods to assess the creditworthiness of the borrowers. This includes relying on previous borrowing history, meaning that those with less than ideal repayment history for previous loans are turned away. And what happens to the ones who have never borrowed before? They have no data, and this is why they're also turned away. Digital lenders, on the other hand, use big data to do credit scoring. They do not rely on credit repayment history or any credit reference bureaus to issue loans, so they can reach these borrowers that banks turn away. The second reason why borrowers turn to these digital microlenders is because they offer shorter loan processing times. How do they do that? It's because they use big data to do credit scoring. Therefore, they can turn around loan applications within an hour, maximum 1 day. This enhances the appeal of microlenders, who people often resort to in situations where they need the cash urgently. The third reason is because financial information is extremely complicated, and nobody understands this better than microlenders. So they package the information with simpler messaging that borrowers can easily understand. A good example is the lender may state that you can borrow up to $100 and repay within 1 month at an access fee of $10. This simple statement cleverly hides the interest rate, and at the same time is easy for most borrowers to understand. Fintechs manage lending risk in two ways. First is that they manage the borrower's limit based on their previous borrowing history. Borrowers are often offered a low limit when they first sign up for an account, and this limit is gradually increased as they continue to repay their loans. Some lenders even require the borrowers to share evidence of how they use the cash by, for example, taking photos of their businesses or other investments that they made with the cash that they borrowed. The second way that fintechs manage risk is through data. Fintechs turn data that they collect into gold by using it to do credit scoring before approving the loans. In traditional lending, Banks and financial institutions rely on data from credit reference bureaus or credit info sharing agreements that they have between themselves. However, with microlending, they use the individual's digital footprint to do credit scoring. What type of data do fintechs collect? Let's look at that. So fintechs collect data around the borrower's mobile phone model, how frequently the borrower changes their phone, the time that the borrower spends on the internet, the borrower's contacts, and they use these contacts to define the borrower's network and the risk profile. They collect the borrower's location, whether they live in an urban or a rural area. They can even tell the borrower's location during the day, in the evening, during the holidays, and any other patterns that they may be interested in. By collecting other information such as SMS messages, they can even find out the individual's purchase patterns and use this to assess whether the person has a regular source of income or not. They also collect the person's call patterns. How do they use the call patterns? For example, an individual with a high volume of international calls may signify that they have a relatively high standard of living. An economist by the name Mohammed Yunus in the early 1970s began offering small loans to women in Bangladesh to help them start income-generating projects to support themselves and their families. This was the path of microlending. Since then, many microfinance institutions have been started across the world. This is because access to credit enables the poor become entrepreneurs, thus increasing their earnings and improving their quality of life. It is for this reason that many microlenders provide some form of peer support network, financial education, and networking opportunities to help the borrowers build successful businesses. However, whether the money borrowed through these digital lending platforms is actually used to improve the quality of life or not remains a big point of discussion. Let us know in the comments what you think about digital lending. Do you think it is achieving its broader objective of improving the quality of life of borrowers? Do let us know, and don't forget to subscribe to our channel.